Hello everyone, welcome back to Upside Down Data. Today I want to talk about Bitcoin's painful day yesterday and what it might mean about where we're heading next. If you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter, where we put out regular updates about our risk indicators and more. So if you've been following the channel, you probably noticed that Bitcoin and the rest of the crypto market, frankly, had a bad day yesterday. Bitcoin was down over 7% on the day yesterday, and there's multiple different reasons why that's probably happening that one could speculate about. There's obviously the concerns about Russia potentially invading the Ukraine in the coming very short term, the next coming days, and all the markets have been showing weakness, probably in no small part due to that uncertainty or concern that might happen. Also, there's just the concerns about monetary policy. The Fed has been speaking kind of quite hawkishly about increasing interest rates, and as well as quantitative tightening, or tightening the monetary policy. So all of that has led to a pretty bearish macro environment. So it wasn't totally surprising to see Bitcoin, and as well as equity markets generally, having poor days yesterday based off of all of that kind of being added on all at once. But I think what we want to ask the question now is, okay, if we just saw that pretty painful day for the markets yesterday, what does that mean? Does that mean that the downtrend's back on, and that we're going to be going back down to lower and lower levels? Or is it possible that we're still going to be able to maintain this kind of upward momentum that we had recently seen coming out of the lows that we had seen back in January? So I want to look at several of our indicators to get kind of a better idea of what might be going on. So I thought a good place to start might be our newly introduced trend confidence trend confidence indicator, or TCI. So if you didn't see the video I put out introducing this, essentially what this model is trying to do is look at the current trend that Bitcoin's price is in. So this is a TCI for Bitcoin, current trend that it's in, and then evaluate whether or not it's particularly confident in that trend continuing, or if in fact it sees that trend as being not convincing and expects moves to the upside. So this uses a kind of new machine learning algorithm that I developed to kind of do this. Essentially what it's looking for is it just evaluating the trend Bitcoin's in, and then it's just seeing, is it behaving the way that the model expects it to behave? And if it's behaving in line with expectations, then it's confident in that particular trend. If it's starting to act against expectations, or becoming a very non-convincing trend, so to speak, then it'll flip to the opposite side. So what's nice about this particular model is that it often will act as a leading indicator. So you can see that in the spring. So yellow is Bitcoin's price. The green or red line here is the TCI output. You'll see that when we were in the spring here, the TCI wasn't particularly convinced of this uptrend. So when the TCI is below zero, that's when it's getting bearish. That's when it thinks that downward movement is likely to be coming at some point in the not too distant future. And so that's why it's colored red here. And you will note that occasionally some green bleeds over. Essentially what that is just it's carrying over the day from the prior daily close, to the next daily close. So if it opened green and then close red, that green will follow down, and this is where the daily close below zero. Likewise, if you're coming up from red into green, like this, then this is going to flip green at the next daily close that's above zero. So that's just why that's happening. But again, you'll see this advanced warning here in the spring that preceded this massive dump to the downside, that 50% correction. But then also in the summer, it ended up flipping bullish well in advance of when we got to the actual bottom, giving an advance warning, right? So it's not trying to call out the exact bottom. It's just telling you, hey, this trend is not very convincing right now. Be watching, be mindful. And then, sure enough, we saw a pretty explosive upside off of that. So that's what this model is really trying to do, is give advanced warning of when a particular trend is becoming non-convincing and when you might expect a change. And the same thing actually happened just recently. So right before that 11% candle day, it actually flipped green. It actually closed above zero, and then we saw that explosive move to the upside. And we've been in the bullish portion now ever since. So even with that 7+% move to the downside Bitcoin put in yesterday, we're actually still in the bullish area here. So it's not convinced that this uptrend is over yet. right? So if it crosses below zero, that's when it will be becoming bearish and thinking that this local uptrend is likely over and that downside is coming. It's not convinced of that yet, though it certainly has become less confident, less convinced of this uptrend than it was before that happened, which obviously, you know, it makes sense. If price just showed a bunch of weakness, you would expect it to become less confident in that uptrend. So what's nice about this model is we can actually basically get it to output what the specific level is that it's watching as being that key cutoff. So as I mentioned, this is a machine learning algorithm that I created, and so it'll constantly be updating this critical level based on new data that it gets and what the current price of Bitcoin is, etc. But currently, as I record this, it's around this level. So around the 37K level is what it's watching as being that kind of critical level between bullishness and bearishness. But again, this is a confidence indicator, so this is more of a continuum rather than a binary. So just because it dips below zero doesn't mean that it's guaranteed the uptrend's over. It's just that if it had to pick a side, it would pick bearish over bullish. But then likewise, if it's only just above zero, you know, if it had to pick a side, it would be bullish rather than bearish, but it's not nearly as convincing as if it's, you know, way up here, for example. So it was a lot more confident of the uptrend kind of coming out of that big explosive move than it actually is right now. But this is the key level, and this is the level that I'm going to be watching as well. And I think it's interesting that 37K is what it identifies as being the split between bullish and bearish. So I think a lot of people are watching 40K right now as being that kind of key level. Now, I do think there are reasons to watch 40K especially closely and still think of it as a pretty critical level, because from this model's perspective, it's not saying that this will necessarily provide support. It's not saying this critical level is a support level to watch. It's just saying that if we lose this level, it's going to flip bearish. And so in some ways, you know, 40K might be a more critical support level than 37K. I'll come back to that later and talk about it. But just from this model's perspective, this is the critical level we don't want to lose. If we can stay above this, then it still thinks that we're more likely to be in an uptrend than a downtrend. If we lose this, then it thinks the downtrend is probably going to be back on. But again, with varying degrees of certainty. The further we drop below it, the more confident it would be in the downtrend. But just the place to look. And generally speaking, when we do cross above or below zero, that has oftentimes been at least somewhat diagnostic. Usually we do continue to the downside if we drop below zero, and then oftentimes we do continue to the upside, at least for a bit, if we cross above zero. So usually this is an important level to watch, although there's, of course, the degrees of confidence that you just have to use in the interpretation. Okay, so that's what the trend confidence interval indicator says. So it's still leaning bullish, although it is getting more concerned than it had been just before that bloody day that we had yesterday. I want to flip over to a different indicator here, the momentum bias indicator, or MBI. So this is not the same as the trend confidence interval, but I have color coded it similarly just because, again, with this indicator being above zero is generally bullish, being below zero is generally kind of bearish, especially if you're below and you're moving down. So what the momentum bias indicator is capturing is the kind of amount of positive versus negative momentum that's present in the market. And by bias, it just means, is there an prevailing negative momentum or prevailing positive momentum? And when you get a lot of prevailing positive momentum in the market, that tends to pull price up with it. When you get a lot of prevailing negative momentum in the market, that tends to pull price down with it. So you want to see the momentum bias indicator spending more time in the green than the red for nice big moves to the upside. And if you see it spending a lot more time in the red than the green, that means that downside is often happening. So that's more of a bear market type behavior, to be more in the red over time. More green over time is a bull market type of behavior. And with the momentum bias indicator, even though zero is kind of that cutoff between them, I tend to see this as being more of a macro indicator. So instead of just watching zero as being such a critical level like the TCI, I see more kind of looking at the trends to be more helpful with the momentum bias indicator. So there's several different things that I think are useful to take from this indicator. So first off, if you want to, you can just use it as a top model. It works quite well for that. You know, every time we've gotten above one standard deviation above the mean. So that's how this is denominated. So zero is the average momentum bias, and then everything above and below is denoted in standard deviations. So when you get one standard deviation above the mean, that tends to be around when you get these market cycle tops or mid-cycle tops. And then when you are you can also look at this as identifying some key bottoming points as well, like the capitulation in the end of 2018, the March 2020 crash, the summer, and then potentially also what we just saw moving all the way down to 32K, although we don't know. It's possible that we could come back down. So what's going on right now, and what are we seeing? Well, one of the things that's quite concerning from the momentum bias indicators perspective is that we had been sort of on track for another move to the upside before we got all this weakness moving in December, moving into January, right? So if you look at the way that the MBI tends to behave during lead-ups to these parabolic moves, it'll kind of do this equal oscillation around zero before exploding to the upside. You see that oftentimes, kind of equal oscillation around zero, explosion to the upside. And we were doing that again coming out of the summer, right? We exploded up, doing this kind of equal oscillation, and then, the hope was that we'd then start exploding to the upside. But instead what happened is we actually broke down, and we came down, and negative momentum kind of won out, and in fact actually increased. We got this really painful negative momentum bias that was really dragging price down with it. Now, we had started seeing a nice recovery off of that with this recent move to the upside, but it's a little hard to see it here. We've actually turned the corner over to the downside a little bit with this recent move down by Bitcoin that it just did, suggesting that we haven't been able yet to establish kind of a net positive momentum bias in the market yet. We've been kind of stuck in this negative momentum regime ever since really the November top or soon after that. We've been just stuck in this point that every time we've been trying to move the upside, just the negative momentum comes back and pushes us back down, which is not what we'd want to see, right? And really what I want to see is that if we do have to come down further, I would like to set in a higher low here, right? Because that might mean that even if we're moving down, we might not be moving down as much. The negative momentum bias might not become as oppressive, which might make it easier then for positive momentum to eventually overwhelm it, push us back to the upside. So getting rejected is not good, but what I'd like to see is it not getting rejected down to the same levels we just were. I don't want to see the same level of negative momentum bias re-enter the market, because that would probably mean we're going into some kind of a bear market, right? If we see some sort of behavior like this, where we kind of just keep on setting lower lows on the MBI, that's really behavior that you'd see in more of a bearish setting oftentimes, or that's not what you want to see. And it's just spending a lot of time in the negatives, which we just don't want to see. That's what we've seen in bear markets. We don't want to see that here. So this is not great from a macro perspective, right? And really where the MBI and the TCI diverge is that the TCI just is worried just about the current trend, right? So even this it would consider as potentially being kind of a new local uptrend, but that could just flip into a local downtrend. The MBI is a little more macro in its perspective. It's caring about this overall kind of net positive or negative momentum bias, and we just haven't been able to reestablish a net positive bias. So that's something that is concerning. That certainly, if we keep coming down here, some of those lower levels could certainly become into play. Retesting the low 30s, even potentially going back to 29, 28K, not unfeasible. And I'll talk a bit more in a minute about some other key levels to watch if we do lose some of those levels. So it's not the end of the world yet. This could just be a blip and we just resume our move back to the upside. But concerning. I don't want to sugarcoat it. This is not what you want to see. If you want to be seeing a build up to a parabolic move, this is not it. This is not what you want to be seeing. This is not the way it generally tends to look. You usually need to spend some time oscillating around zero before you can put in that move. We had that, we lost it. We're probably gonna have to do that again before we can go up. So to think that we can just immediately shoot off the all-time highs from here, I think is pretty unlikely. I think we're probably gonna have to spend some time reestablishing a positive momentum bias before we might be able to put moves to the upside, assuming we're still in a bull market, right? Obviously, if we're going into a bear market from here, then all bets are off, and this could spend, months, even years down in this low level like we saw back here. Hopefully not years, hopefully it would just be months, but it could spend some time. So something to keep an eye on, something that is a little bit concerning. So in the kind of the shorter term localized setup, still have some reason to be bullish, but this is not particularly bullish yet. This is still leaning towards the bearish side. But I want to provide another perspective as well. So let's flip over to our risk indicator, the upside downside potential indicator. So if we're kind of taking our time preference out of the equation here, we don't really care if this is the uptrend that'll dig us out of this bearishness. If we're not really too concerned about that, if we're more just concerned about, historically speaking, might this be a good accumulation zone or not, this is where I think the upside downside potential indicator gives a different perspective, right? So if we look at this indicator, you'll notice that in these green zones, these lower risk zones, in the context of history, they've looked quite good, right? Even if you've been acquiring here, shortly after the top in 2013, That looks incredible. Buying well below $1,000 just by the end of the next market cycle up around $20,000. Anyone would be happy to have done that, even if they would have had to endure quite a bit of pain in the meantime before they went there. Same thing with something like the bear market in 2018. Even if you bought at some of these greener zones here, there's some shorter term pain that ended up happening. These not being the lowest levels of risk, getting all the way down here in the 2018 capitulation. But still, in looking backwards, buying at these levels looked quite good once we got up to around 60K, right? Anyone would have been happy to do that. Same thing here. So we're back in this green zone again on the UDPI. And, when you look at these green zones, they do happen at the beginning of bear markets, right? There's no denying it. It certainly could be that we're about to enter a bear market and there's more pain to come. But it wouldn't have to be. It could be something like the summer where we're going to go back up, so you don't know. But in time, historically speaking, it's always been the case so far that buying green has, with time, looked fantastic in the long run. Now, it's not financial advice to say that you should just be, I'm not arguing that you should be dumping all your money into the market right now just because we're in the green zone, because obviously more pain could come. You should make your own decisions. But I do just want to give that other perspective, that if you zoom out enough, in these kind of levels that we're at right now, so far with Bitcoin, it's never looked like a mistake to do that. Now, of course, this is all assuming that we don't get some kind of stock market crash, or that there's not some big collapse across broader markets that just tanks Bitcoin and makes historical patterns meaningless in the context of what would come. This is all kind of assuming that historical trends remain predictive of what we might be able to expect in the future. But assuming we don't get some horrible black swan event, or the stock market doesn't completely collapse or something like that, my speculation, if I had to choose, is that with enough time, this will look like a good accumulation zone. If I had to pick a side, I think we will see that next leg of the bull market at some point. When? Who knows? We might have to move down further first before that happens. But with time, I do think that this will have looked quite good. Maybe not might not end up being the absolute best entry point, but certainly a good entry point nonetheless. So again, not financial advice, but just one perspective here. So certainly this can set the stage for upside. We've seen that coming out of the summer. These levels have provided that in the past. And frankly, you'll see these kind of levels even in uptrends in bull markets. But it's also, you have to keep in mind that, you do see this kind of thing even when you're entering some bear markets also. So you just want to keep that in mind. So let's look at the raw output of the UDPI just to get some other information out of it, other perspectives. So this is the raw output. So UDPI on the Y axis here. One thing that I think is notable and something to watch that I do think provides some kind of bullish information to some degree, not definitive by any means, but is bullish, is if you look at the structure of the UDPI output over time and compare it to how it's behaved in past market cycles. One thing you'll notice that when we get into bear markets, so even starting at the beginning here in late 2011 going into 2012, you'll get this kind of low point set on the risk level that tends to happen at the kind of the bottom of the bear market. So usually that's dipping below this -4 band. Oftentimes that's going to be when you're seeing that market cycle or the bottom of a bear market if you're in a bear market. And then what you'll see is, generally speaking, higher lows on risk up until the ultimate peak, market cycle peak, right? So you see this here. So these bottoms are about the same point, higher bottom here, top, right? Down to a bear market where we're setting in lower bottoms, lower highs, but then we set in our ultimate bottom. We set in about the same, I think actually a little bit technically higher here, but it was more or less a double bottom for this bear market. These two price levels were basically the same. But then you're setting in, generally speaking, higher lows as you're going up to the ultimate market cycle top. Then you're coming down, setting in lower lows, lower highs into the bear market bottom, and then you're setting in higher lows on a macro scale up to what might be the ultimate market cycle top. So from that perspective, this has maintained a bullish structure on risk, even though there's certainly been a lot of pain. Because look, we had reversed our long-term risk quite substantially. So I should know I'm showing you the long-term UDPI here. So this cares about moves that play out over months to years. So this is capturing that kind of broader, more macro moves in risk in Bitcoin. And I think this is the most useful one to talk about right now if we do care more about where Bitcoin might be going in a macro perspective. So I do think this is one one point for the bulls here potentially where we have maintained a bullish structure in terms of risk. And really the way that the way you interpret this is that every single time we've gotten these crashes or capitulations of the downside, we've consistently been realizing less downside potential than the model saw as being plausible every single time. So every single time we've capitulated, we've realized less of that downside potential. We've capitulated less far in terms of what's realistic than the previous time. And that's similar to what we think about as being a healthy market structure from a price action perspective, right? Where you want to be setting in higher lows, for example, as you go up. That every single time you set in when you're setting in a low, you want it to be higher than the previous low from a macro perspective moving up. And this also does kind of align with price action because we kind of have so far been doing that, right? That if 32K stands as being the low point of this current period we're in, that was still higher, technically speaking, than 29, 28K, which was the low from the summer, which is obviously going to be higher than the low we put in back in the March 2020 crash. So this is all part of one market cycle. We have so far maintained a bullish structure. So where I'd get concerned is if this collapses below what we saw in the summer. So if we do end up dumping off of here or really showing weakness, if risk ends up falling, then that could suggest that we've lost that bullish structure. We might end up going back to revisit some of these really low risk levels at significantly lower prices, potentially, if a bullish scenario or a bearish scenario plays out. So far, we haven't seen that, though. So I do think that's one point for the bulls, potentially, just from that perspective. And if we want to zoom in and look more at the short-term risk, so that's what I'm showing you here. This cares about moves that play out over days to weeks. One thing that I think is giving a different perspective here from the long term, so again, this is more macro, this is more short-term, is that move that we put up, we had actually broken above zero, so that's where the upside potential was then lower than the downside potential in the short term. So seeing a correction off of this point and then letting this cool off is not unheard of or unexpected. And in fact, it's probably just healthy for us to do that, because you'll notice that every time with the short term that we've gotten up to these really kind of extended levels in recent history, so going up there in September, October, going up there again in November, we've seen those kind of deep corrections off of it. So in some ways, not getting so overextended to the upside, not realizing so much of the upside so quickly might be good. It might mean that we don't have to correct so far down before we can pick up again. So I'm going to be watching this and also seeing, can we set in potentially a higher low here, because that might mean we can start resetting up for the upside, right? You'll notice that the summer here was lower than what we got in September, which might have set up that all-time high. I'd like to see that again, where if this is our low, maybe we can set up a higher low, move up to the upside. Have to wait and see with that. But overall, with the indicators that we track on this channel, I think there's kind of different perspectives that we're getting presented with, right? So from the TCI's perspective, it still sees this as being more likely to be an uptrend than a downtrend. It's not convinced yet that the uptrend is over. We'll really be watching that 37K range as being that kind of critical level that it would decide, all right, this is not looking like an uptrend anymore. And the closer we get to that, the more bearish we become, right? The less confident in the uptrend it would be getting. So, you could even get bearish before 37K. You wouldn't have to wait for it to flip zero if you want to kind of jump the gun to pull bearish. But certainly we're not there yet. With the MBI, we are unfortunately still sitting in a negative momentum bias kind of world right now that hasn't broken yet. So we'd like to see that change. So that's a point to the bears, I think, right now that's happening. And then with the EDPI, I think it's there's a point for the bulls in the fact that its structure still is consistent with a macro uptrend or a macro bull market. But certainly getting down to these low risk levels can be the beginnings of bear markets. And so it's not to say that we can't dump off of here and have risk fall way further lower. And then it would be more when we get down to here that I might expect that would be more likely to be the bear market bottom, because that's tended to be the case throughout history. Although certainly in a black swan event where the market crashes, all bets could be off in that kind of a scenario. So kind of what I'm seeing here is that this short-term weakness is totally plausible, totally feasible, but doesn't necessarily invalidate the uptrend, but certainly it's something that we should be watching very closely. And I think it's pretty premature to say that we're still definitely in an uptrend or that we're not going to be heading to lower prices. But I think currently we're not at the point yet where I would say that flipping bearish is something that you have to do, right? I think there's enough of the data flipping bullish that there's a reasonable case to be made for the bulls. And then there's also obviously going to be the bears who are saying, look at what happened with that with yesterday, it's a disaster. So I just want to flip over to Tradingview to kind of wrap us up. Notice we're trading right around 40K, which is what a lot of people see as being a pretty critical level. And I think that makes sense. So I've put on this white line here, more or less the region that the TCI is watching for, just to give you a perspective of where that is. So it's right around the 37K. It's all going to be updating as it goes. And in the coming days, this level could actually rise, it could fall, just depending on what the model's looking at and what it's expecting. So that's just one level to keep in mind. But the level that a lot of people are watching is this 40K level. And I think for good reason, right? Because if we look back throughout kind of this whole kind of range-bound year we've had, this level has acted as a pretty critical level throughout a lot of the time, right? So it's acted as resistance back here in January 21, resistance again in the summer. We kind of got rejected on that relief rally back down. We kind of interacted with here. It wasn't the definitive level, but we kind of bounced off of it in the September bottom, so providing some support down here, and then support again here in January before breaking down below it, and then now we're testing it again, potentially trying to flip it back into support, hold a support again before being able to move back up. And one of the things that's concerning if we lose 40K is that there's not a lot of other great support levels left, right? So that 37 critical level that the TCI is watching, that's not really a support range per se. You look at it, there's not really a whole lot that's critical that's happened here, except for maybe kind of holding a support here, and then, we've interacted with it here, but it's not to say this was kind of the critical level. So if we fall down below 37K, that's where, in some ways it kind of makes sense that the TCI is seeing that being such a critical level, because there's not really much to look at after that, right? Then we're talking about this general range that we just held as support back here in the low 30Ks. But if we lose this level, then we're talking about, down here into 30K, 29K, etc. as being the next level. And then if we break that, that's when it gets really worrisome, because then the floor kind of falls out, right? Like, where do you look for the next level of support? I think what a lot of people would point to as being kind of the 200-week moving average. That's this red line here. And if we zoom out, that actually kind of more or less coincides with the market cycle top all the way back in 2017, right? This is kind of being that next level of support, and also where it acted as resistance, coming up in November of 2020 here. So really that would be kind of that next level that we would look at after we drop support at these levels. So I think these are some critical things to look at. Now, obviously, this is pretty doom and gloom to some degree, that we're not there yet, so it's a little premature to be calling for us to revisit the 200-week. But it's just that if we lose 40K, then this is the next critical level, in my opinion. If we lose this level, this is the next critical level, in my opinion. And if we lose this, that's when it gets really concerning, because there's really we just blew through this so fast that there wasn't really time to be building up any kind of critical resistance support, kind of critical levels in this zone. Really, the next place we'd look is probably around the 200-week, which coincides with this previous market cycle top as being hopefully kind of the worst case scenario. Although, again, in the case of a stock market collapse or something like that, then we're kind of dealing with a completely different scenario where all bets could be off in that kind of situation. But anyway, so that's not to say that has to happen. So I think what we need to be watching right now is 40K. If we can hold 40K, and especially if we can catch a bounce off of it, that's going to be great. TCI will become more confident in the uptrend. Hopefully we can set in a higher high. Maybe we can start to reclaim some of these higher levels. Probably won't be painless. We'll probably have to be chopping around, but hopefully be able to maintain higher highs, higher lows would be a bullish move from there. But if we break down, then in my opinion, we got to hope we can set in at least hold this level or set in a higher high down here. If we don't, then really, in my opinion, we've got to just hope that we hold this level, because if we don't, I think that's when I would be seeing this as being that next level. All right, so this will be interesting next couple days to weeks to watch. So we'll see. All right, if you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter. And remember, with UDPI and the TCI and the MBI, we're all going to make it.